So let's start talking about stock or equity, right? So what I want to try to do is kind of get you guys for a feeling of why companies are going to use convertible notes or safes rather than just selling common stock or preferred stock or equity in the company. So in order to kind of effectively do that, I want to make sure everyone has a basic understanding of what stock really is. So stock is ownership in a company, okay? And by ownership, that means the person has a claim, whether preferred or common, on the assets and earnings of the company. So for example, if the company sells all of its assets for, let's say, $100 million, and $100 million comes into the company, then the owner of the stock has a claim on those assets, typically corresponding to what their percentage ownership interest is in the company. What rights and benefits the shareholder has depend upon the type of stock that the owner has. So for example, there's common stock, there's preferred stock, and then there's a whole bunch of different series of preferred stock. You can have a Series A, you can have a Series B, you can have a Series C-1, C-2. You can just, as the company continues to do preferred rounds, you continue to designate it typically with acronyms like that. So how do you define or determine what the terms of the company's stock are? And that's all done through negotiation. So the investor will typically negotiate with the company what the terms of the stock are, so that the investor is then comfortable basically buying the stock and the capital going into the company at that time. But the really important factor that I want to convey is that the person who owns stock is a shareholder. In other words, they are an owner of the company. So a little bit more on the terms of the stock. If someone has common stock, then basically they have typically the lowest right of ownership, preferred stock being preferred over the common. The terms of the preferred stock, if any, in the company are typically, again, negotiated between the investor and the company. The typical terms that you're going to see in a preferred stock are going to be dividends, okay? And think of dividends as really a return on the person's capital. The company may pay dividends if it has excess profits, but typically in a startup, it's really more of like a note that's basically accruing interest. It's a right for somebody to receive a return on their capital when the company sells or liquidates. Liquidation preference is exactly that. It's what the person has the right to receive when the company sells. The person may also have conversion rights. That basically means that their preferred stock can convert into common stock. Anti-dilution protection basically means that we're going to give the investor some protection against later rounds that may be sold at a lower price than what the investor paid in. Protective provisions are things that do exactly that. They protect the investor from basically corporate actions for which they want to have a say or a veto right. So for example, a lot of investors don't want the company to have the right to sell to another party without their rights. A number of investors don't want the company to incur debt obligations, right? So it basically gives the owner more protections than it would have, more than its percentage ownership. So for example, a preferred owner may only own 20-30% of the stock, and the other stockholders are going to own 70%, which means they're going to control the company. And without protective provisions, the 70% shareholders could basically drive corporate decisions without any input from the investor. And as you can imagine, most investors aren't going to want that to happen. Redemption rights are rights where basically the investor can put the stock back to the company and force them to buy out the investor. Typically, they'll pull the trigger on that if the company doesn't look like it's going to perform to the satisfaction of the investor. Okay, so I do a whole presentation which basically will spend over an hour talking about just these terms, but that's really not what our focus here. I just want to give you a little general sensitivity to the types of rights that people will have as a stockholder of the company, as opposed to kind of a deep dive into what all these things mean. Okay, so again, stockholders are owners of the company. The rights that they have as a stockholder are negotiated between the company and the investor. And those rights that are negotiated determine what the investor's rights, voting rights in the company, and its right to liquidation and various things are all determined by negotiation. And then essentially those rights are enshrined or put in a charter that's filed with the state, so everybody knows what they have. So let's kind of segue then into convertible notes, okay? And then we're going to kind of convey to you guys what the difference is between this and equity, all right? So First, the most important thing to understand about a convertible note is that we're talking about a convertible promissory note, okay? It is a debt instrument. In other words, the investor is essentially loaning money to the company, which means that the company owes that money to the investor and has to repay it based upon the terms of the convertible note. In contrast, in stock, when the person basically buys the stock, the money's put into the company and the company has no obligation to pay that back, except, for example, maybe in a circumstance, where the holder has a right to put the stock back to the company and force the company to redeem and buy them out. Okay, but those are typically pretty rare. So the main difference here is, unlike stock, the person who makes the loan to the company by a convertible note has the right to get the money back, okay, if certain things don't happen. So, but in addition to it being a debt instrument, if the company does well, right, the investor is not just in this to get a return on its investment, in other words, interest on the promissory note. The investor wants to get a return of an equity type of return. And so the note is convertible into stock of the company. What it's convertible into is going to, again, be the results of negotiation. But the important thing to know here is that typically the convertible note will convert into equity based upon a qualified investor making a qualified investment. And what we mean by a qualified investor is we don't want this note to trigger or convert into equity, just because some mom and pop may do a transaction with the company. The investor wants to make sure this is a bona fide, legitimate transaction. And so we'll typically make sure that the investor has to be a sophisticated investor. Maybe there's a minimum dollar amount to the investment. Maybe it has to be at least $1 million. But what the trigger is going to be determined in the convertible promissory note. And also, we have to make sure that the person makes a qualified investment, right? And a qualified investment typically means we have a certain dollar amount of threshold to make sure that this is a legitimate third-party negotiated transaction. The investor is not going to want to give up the convertible note unless it is a legitimate bona fide transaction that fairly values the company. Now, unlike the person who's a holder of stock, because this is a debt instrument, the holder of the note is not an owner, but they're a creditor, right? The company basically owes them money. They're a creditor position, which means they have a right to be paid back before any of the stockholders of the company can receive payment. So when a company sells or liquidates or go bankrupt, there's a hierarchy. Okay, the first people who get paid when a company sells or liquidates are the creditors. Creditors have to get paid first. Then it goes to the preferred stockholders, if any, and then it would go eventually to the common stockholders. So the benefit here, obviously, is that the holder of the convertible notes gets paid before the equity. Now, because this is a debt instrument, the things that have to be negotiated are debt features, right? So for example, what's the interest rate? Is the interest rate 4%, 6%, 10%? All that's negotiated. What the interest rate tends to kind of mimic what the market is. So in times of higher interest rate, the note tends to have a higher return. Lower rate environment, you're basically going to see lower interest rates. Then we have to look at the maturity date. Maturity date means, when does the company have to pay the note back? Okay, if the note doesn't convert into equity, it has to be repaid. Typical maturity dates, I would say, be about 2 years. Sometimes I see them as long as 5 years. But at the end of the day, this is negotiated between the company and the investor, is that if the company doesn't have a qualifying event where the note is converted, we need to know when the note's going to become due. What are the payment terms? Okay. Is there going to be any obligation for the company to make payments before the note converts or become due? For example, maybe the investor wants interest paid quarterly. Maybe interest is paid annually. Maybe interest isn't paid at all. Maybe it just accrues, and so that when the note converts, we basically convert not just the principal amount, but any accrued and unpaid interest. Ranking of the note. Okay, what that means is, if there are other notes out here, who gets paid first? Okay, is this a senior secured note, which means that it has a higher hierarchy on the liquidation waterfall, then perhaps a junior subordinated note, right? So we have to figure out where the notes all kind of fall in line and who has the right to get paid first based upon the ranking and the priority of the notes. Since it's a convertible instrument, we want to know what happens if the company defaults. So for example, what if the company is sued? Does a lawsuit against the company trigger a default situation on the note? If the company has an obligation to pay quarterly interest, what happens if it fails to pay one of the quarterly installments? That's going to typically be a default. And so we're going to have in the note default provisions, so we know what the rights are to the investor should the company basically not honor any of its obligations under the note. Now, the note can be secured or unsecured. If the note is secured, that means that there's some collateral owned by the company that stands as collateral in case that the company can't repay the note. So for example, maybe the note is secured and the collateral is a patent, or maybe it's some other, maybe the company has some equipment that's very valuable. Anyhow, at the end of the day, most convertible notes are not secured, but in many situations they are. It's just one of the things that has to be negotiated between the company and the investor. Then there's always the question of whether or not that the company can prepay the note. In other words, once we've defined, let's say, for example, that the terms of the note is that it accrues interest and everything's repaid in 2 years. Well, what happens if the company is doing really well and it's generating cash and decides that it wants to prepay or pay off the note early? Now, from the investor's point of view, they may not want the company to pay off the note early because that takes away the money that would be used to convert the note, right? If I have $1 million note, and the company's doing well, then I would want the full amount to convert into the company's equity. On the other hand, if the company's not doing well, maybe I'd be happy to have the company prepay the note so that I'm kind of minimizing my risk of what capital has been invested in the company. So very typically, companies may have the right to prepay the note, but typically it's only with the permission of the investor, right? The investor doesn't want the company to prepay the note if the company's doing well, and conversion into equity would be a very beneficial transaction on the part of the investor to take equity rather than the debt instrument. Now, much like we had to talk about the terms of the equity that are negotiated with the common stockholders, we have to negotiate what it is that this note converts into and what its equity features are. So what is the conversion stock? Is a conversion stock common? Very atypical. More likely it's going to be a preferred stock. If it's going to be a preferred stock, what are the terms of the preferred stock? Very typically, these notes will convert on the company's next qualified financing, and typically they will convert into the financing stock that the new investor basically negotiates with the company. So it's kind of the situation here with what's good for the goose is good for the gander, right? In other words, from the investor's point of view, is if a legitimate bona fide third party comes in and makes an investment in the company, I'm going to basically respect the negotiation between those two, and I'm going to basically respect and take the stock that's negotiated between the two. Other terms that need to be negotiated are when the note converts. Okay, very typically it's going to be when the company has a next round of financing. But what happens if the company never has a next round of financing, but let's say it's selling product and it's generating a ton of cash and the company's doing extremely well? Well, the investor is going to probably want to have the right to convert even though there's not a next round of financing. And so we have to look at that situation and decide, number one, what price it converts at, and number two, into what type of stock. And so generally speaking, we may kind of have in the note, because again, this is in the absence of another transaction where someone has actually negotiated the terms of the financing. This is specifically in a situation where there's been no financing, but the company's doing well and the investor wants to convert anyhow. So we're going to have to specify in advance what the terms of the stock would be in that type of situation. Very often in convertible notes, we're going to have a valuation cap. Okay, the valuation cap is going to basically say that the note's going to convert at this price, but let me say this differently. Typically, the most common provision in the note is that the note will convert into equity and usually at a discount to the price that the new investor is paying. So let's say the new investor is coming in and getting Series A preferred stock. They're paying $1 a share. The note would typically say that it's going to convert into the same stock as the new financing, here Series A preferred stock. And very typically it says it will convert at a discount to what's being paid by the new investor. So if there's a 20% discount and the new investor is paying $1, then it's going to convert at 80 cents. Okay, and why that's the case is because this money comes in before the Series A preferred financing, which means the convertible note holders are taking on more risk. Because they're taking on more risk, the discount here means that they're going to have a better economic return than the Series A preferred stock. And the intent is to reward them for, again, coming in early and taking the earlier risk in this type of situation. Now, coming back to how it converts, very typically, it'll be a mandatory conversion. In other words, it'll happen automatically, whether the investor wants it or not, if we have this qualified financing. And very typically, we may have situations where there's a voluntary conversion, which basically means where the investor can convert if they want to, even though if there hasn't been a qualified financing. And very often in a mandatory conversion, sometimes we have a trigger that basically says, even if we don't have a qualified financing, but let's say 2/3 or 80% of the investors want to convert anyhow, then we're going to force and drag along all the other people to do it. So that's another situation where we tend to have a mandatory conversion. The reason is if enough of the investors want to convert, we don't want to have a bunch of smaller investors still hanging out and being note holders. We want to drag them and force them to convert just like everybody else. Okay, I know I went fast. I know there's a lot of stuff we talked about, but I'm just going to pause to see if there's any questions at the moment. And just speak up, or if you do.
I think I have a question. I was just like wanting more clarification about the valuation cap and then like the investors, them receiving a discount. So can you like kind of explain that a little more?
Yeah, certainly. Thank you. Because you're right. I never came back to the valuation cap. So let's start with the discount. Okay. So in the scenario that we gave, the example I gave was that let's say that the convertible note holder has the right to convert into the same stock at a discount to the price being paid by the new investor. Okay. So if the new investor paid $1 a share, then at a 20% discount, the note's going to convert at 80 cents a share. Okay. So let's say, for example, that the investor put $100,000 into the company, and let's not worry about interest or anything like that, just to make the math easier. But if we're in the situation where we have $100,000 of principal amount, then that's going to convert at 80 cents. Okay. And so let's pull the calculator real quick. So what we would do is we take 100,000 and divide it by 80 cents, which means they're going to get 125,000 shares. Okay. Where the Series A investor, they're paying $1 a share, which means for 100,000, they're going to get 100,000 shares of preferred stock. Okay. So you can see how the convertible note holders are doing better. They're going to get $125,000 worth of shares for their original $100,000 investment, where the new Series A preferred investor is only going to get 100,000 shares. So again, the additional 25,000 shares in that circumstance is to reward the investor, for the convertible note holder, for coming in earlier, being the earlier money, and taking on the additional risk. Now, a valuation cap is going to come in. Let's say, for example, that for the convertible note holder, let's say they came in and the company was probably valued at around $1 million. Okay, just to throw out a number. Had they done a common stock financing, they could have come in and received common stock of the company at $1 million valuation, right? So let's say they put 100,000 in, the company would then be worth 1.1 million. In other words, $1 million pre-money valuation, adding 100,000 in stock, which puts the company at a post, 1.1 million valuation. The investor would then own 100,000 of the $1.1 million company. Okay, which works out to be roughly around 90% of the company. In other words, they'd have roughly around 10, 11% of the company. So, but let's say that that's the scenario, right? The convertible note holders come in at the company being around $1 million valuation. And let's say the Series A preferred stock comes in, and by the time the Series A preferred stock comes in, the company's now worth 20 million. So for the investor to get a 20% discount, they're really coming in effectively at a $16 million valuation. Well, that's not a great day for the investor, right? Because they could have come in at $1 million valuation, bought stock of the company, but because they did a convertible note and because the company grew a lot after their original investment, they're really losing that incremental valuation of the company, right? So what the valuation cap does is that operates to protect the convertible note holder from the company growing quite quickly. And so, for example, let's imagine a scenario where the investor had a $6 million valuation cap. And what that means is that even if the Series A investor comes in at a $20 million pre-money valuation, they're going to convert at $6 million max. Okay. The Series A is going to, their shares are going to be valued. They're going to come in at the $20 million valuation, but the convertible notes, because there's a $6 million valuation cap, means that they're going to convert at effectively a $6 million valuation. And they're going to get a lot more shares per dollar than what the Series A preferred holders are going to receive their shares at. Does that help clarify it a little bit better?
Yeah, definitely. Thank you. I had it backwards at first, so thank you.
Okay, well, thank you for asking the question because I'd absolutely neglected to go back to the topic. Any
No
other
problem.
questions on convertible notes before we move on to safes? Okay, let's jump into safes. So SAFEs is an acronym for Simple Agreement for Future Equity, right? That's where the term SAFE comes from. And the point to know here is that the SAFE is an instrument that is convertible into stock of the issuer, much like a convertible note. And in fact, the terms can be very similar or nearly identical. But unlike a convertible note, the SAFE is not debt. That means that the holder of the SAFE, unlike a convertible note holder, is not a creditor. That means that the company doesn't have to repay the SAFE. And it means that the SAFE is not reflected on the company's financial statements as the debt or liability. So the company's financial statements look better because there's no debt, on the financials. So much like the convertible note, the total amount of the SAFE will convert into equity when a qualified investor makes a qualified investment. Okay, they operate very similarly in that respect. And again, just to reemphasize that, again, unlike a convertible note, the holder of the SAFE is neither a creditor, and unlike the holder of stock, they're not an owner. So it's kind of a hybrid in between. So the holder of the SAFE really just has a contractual right. They're just really a party to a contract that allows them to get equity into the company if there is a qualified financing and based upon a qualified investment. Now, because it's not a convertible note, we don't have to negotiate or worry about going back to the convertible note debt features, right? There is no debt here. It's not a debt instrument, so we don't have to negotiate any debt terms. But like the convertible note, we do have to define the triggers by which the person receives equity in the company. And you're going to look at these categories, and it's pretty much everything we just talked about before, so I'll move through it a little bit quicker. But we have to negotiate the equity feature, right? When is the person able to convert the SAFE into equity? Same talk as before. What's the conversion stock? Is this converting into Series A, Series B, Series C? Well, again, that typically depends upon what the next investor in the company negotiates as to what they're going to receive in the company. So if the next round of financing receives Series A, then the SAFE here will convert into Series A. When does it convert? Similar to our discussion of the convertible note, typically converts when there's a next round of financing, right? The qualified financing of qualified investment. Much like the convertible note also, maybe it will convert if 2/3 of the holders of the SAFEs want to make a voluntary conversion, and maybe anyone would convert voluntarily at any time. What's the conversion price? Same issue we had in the convertible note. Typically, it converts at a discount to the price paid by the next investor. So if the next investor paid $1, if we had a 20% discount, the SAFE's going to convert at 80 cents on the dollar. Much like the convertible note, if there's a valuation cap, that will protect the holder of the SAFE from the company growing in value and basically the investor losing that value, right? So for the holder of the SAFE here, it's much better for them to convert at a lower valuation than a higher valuation. So what that cap on the valuation is again something that's going to be negotiated between the holder of the SAFE and the company. And as before, how it converts, which we've talked about, mandatory conversion, typically if there's a qualified investment and a qualified financing, typically mandatory. If a certain percentage of the holders of the SAFE want to convert, then we're going to drag along everybody else. And because voluntary conversion is usually a good thing for the company, typically they can do a voluntary conversion at any time. So just to wrap up, so the main difference is convertible notes debt, SAFE is not, but for all intents and purposes, they operate very similarly when it comes to how they convert into equity of the company. Okay, so the next question then is, well, when would the company prefer to use convertible notes or SAFEs over equity, right? I mean, what are the reasons why the company may prefer to do so? So, and this is not one size fits all. I mean, there's various factors that drive whether or not the company, number one, is interested in doing convertible notes or SAFEs, and maybe the company just wants to sell equity, but there are some factors here that will drive that decision. So some of the kind of reasons why a company may prefer SAFEs and convertible notes over equity is because, you know, kind of the argument is that they're simpler and easier to conduct. What that means is that we don't have to negotiate all the terms of the preferred stock at that time, so we can do it quicker and easier. There's less documentation typically, right? So if we're not negotiating the terms of the preferred stock, we don't have to worry about drafting this 20-page document that we have to file with the Secretary of State, which effectively creates the stock. SAFEs and convertible promissory notes tend to be maybe like 4 to 6 pages. So they're much simpler and shorter and less drafting, less documentation. So again, the whole idea here is that it's easier, quicker for the company to get these deals done. You know, again, shorter paper, less documentation, fewer deal terms to negotiate. Remember when we talked about equity, we have to negotiate the terms of the equity, right? We have to talk about dividends, liquidation preferences, redemption rights, conversion features. All those things have to be negotiated. With the convertible note in the SAFE, lots of times we're just going to say, hey, it's going to convert into the stock that the new investor uses in the qualified investment. So we don't negotiate it. We basically punt. We basically wait for the new investor to come in, let them negotiate the deal, and that's what's going to basically be used for the conversion equity in our documentation. So again, we don't negotiate that necessarily here. We're waiting for it to happen in the next round. And all of these things typically means less legal fees. Okay, you know, from my experience, when we did early stage rounds for companies, the legal fees would probably be anywhere from $20,000 to $30,000 to do a preferred stock round, where we could do convertible notes and SAFEs for just a few $1,000s. So they were much cheaper, faster, and easier to use. And that's the advantage for a lot of companies. One of the other principles here is that they defer the pricing decision. Okay, so it's hard to value a startup, right? It's not like a more mature company where we have, you know, typically there's formulaic approaches. More mature companies are typically valued at, for example, a multiple of revenue. Maybe they're valued at a multiple of EBITDA, which is, you know, kind of earnings before interest, taxes, depreciation, and amortization. The problem here is that most startups, at least at this stage, they don't have revenue. They don't have earnings. If they don't have earnings, they don't have EBITDA. So all of these kind of formulaic approaches that are really handy for valuing more mature companies just don't work with a startup. And so what we're basically saying here is that we're not in a position where we want to put a value on the company. And let's let the next guys who are smarter than us come in and value the company. And then we'll basically trigger the conversion rights here based upon the next valuation of the company. Now, to a certain extent, that argument works. On the other hand, if you remember, if we're going to do a valuation cap, we have to kind of have a general idea what we think the company's worth. And valuation caps are usually something a little bit more than what the company's currently worth today. So all I'm saying is, you know, it's a little bit off to say that we don't have to value the company because there is some element of valuation in doing the cap. But for the real hard part of what the investor is going to get, we don't have to really value the company. And because we're not really looking at what the value of the company is, the only real big negotiation, at least the argument would be, is that we just have to agree upon the discount. You know, what's the discount? What's the valuation cap? But again, they don't necessarily mean that we have to be precise on the valuation of the company. We can be more imprecise and just have a ballpark, and that's all we really need to do these things. They also protect against dilution. Okay. One of the advantages of punting the decision to the next round of financing is that the hope here is that we're going to convert these at a valuation higher than today. Okay. So for example, in the example I gave earlier, remember where we had roughly $1 million valuation of the company at the time we do the convertible notes or the safes, and then a $20 million on the Series A. If we're going to basically take the investors' money at the $1 million valuation, then they're going to get a bigger stake of the company, right? If they put $100,000 in, $1 million pre-money, 1.1 million post, we're looking at like a 9%, percentage of the company. If these notes or safes converted at 20 million, then that 100,000 is only going to be, like half a percent, right? So I mean, it's going to be a much smaller piece of the company. And so it's to the company's advantage to delay the conversion until the company has a higher valuation. Now, from the investor's point of view, that's why they want the valuation cap, because they're willing to allow the company to have some growth in valuation before they convert, but they're not going to want to leave everything else on the table. Again, that's where the valuation cap comes into play. Also, another reason why companies prefer convertible notes and safes is that because the holders are either creditors or just people holding contractual rights, they're not owners, they're not holders of stock, they don't have voting rights. Okay, typically holders of common stock or preferred stock of the company have the right to vote in elections and various other circumstances where the company may have to put the vote out to the ownership of the company. So in this case, we don't have to worry about chasing these people to get their votes. So it's easier for the founders to maintain control of the company. And we don't have to necessarily worry about the holders of notes seeking protective provisions, which would basically give them certain veto rights over certain company actions, such as sale of the company, which we talked about earlier. So those things will come downstream when the notes or the safes convert into equity, but for the time being, the founders, it's easier for them to maintain control because what they're selling here doesn't give people voting rights in the company. So those were the reasons why the company might prefer to use convertible notes or safes, and let's look at some of the reasons why the investors might prefer to do so as well. So same argument here. They're easier, right? And so simpler and easier to conduct, less documentation, fewer deal terms to negotiate, everything that we talked about in the prior slide. Now, in the case of notes, but not safes, they're considered safer. Okay, so convertible notes are debt, and we talked about that earlier, is that creditors get paid first when the company sells or liquidates. So in our liquidation waterfall, creditors first, preferred stock second, common stock third. In addition, because it's debt, obligations can be secured. In other words, the company can have to put up collateral. So the company can put up intellectual property or other assets as collateral. So if the company fails and really has no ability to pay the creditor, again, the convertible note holder appear back, then the convertible note holders could, for example, take the company's patent, put it up for sale to the highest bidder, and then take those proceeds to pay off its note. So it's a safer position for at least holders of convertible notes to be in a credit position than to be in an equity position. Now, why may the company not want to use convertible notes or safes? So one of the arguments is that they can be complex. Okay, so for example, what if the company doesn't have a next round of financing, right? It's real easy when these things are triggered by the next round of financing. Why? Because in determining what it converts into, we're just saying, look at what the new investor is getting. Based upon those terms, we don't have to worry about those, right? We're just kind of kicking the can down the street here. So if things are going well, then the company, and even if there's no round of financing, but if the company's doing well, we have to negotiate the other preferred stock, right? And that's where it gets complex. So company does well, the investor wants to convert. The question is, what do they convert into? All right, well, they're going to convert into the next round of preferred stock. All right, well, what's that? Well, then we have to decide what the liquidation preference is going to be, what the dividends are going to be. And as you can imagine, we're pretty much negotiating all the terms of the preferred stock just as if we were doing a preferred stock financing. So it can get very complex in that type of situation. If the company's not doing well, then we have to talk about how is the investor going to get their money back without destroying the company. In other words, if the company can't afford to pay the investor back, it's in the investor's interest to keep the company alive and solvent. So we have to kind of structure a payback scenario in a way that makes sure the company can pay. And again, that can be complex. Other issues are what happens if the company sold before the maturity date and before the convertible notes and the safes convert? What do they convert into? What type of equity? Again, so although kind of the typical words of wisdom are that convertible notes and safes can be simpler and easier and faster, what I'm just going to share with you guys is that there are scenarios here, and when you dig deeper into it, these things can actually get fairly complex. Another reason why a company may prefer not to use at least convertible notes is what if the company can't service the debt? Remember, one of the things we talked about in the convertible note is that because these are debt instruments, we have to basically talk about when they're repaid. So what happens if we have like a quarterly interest repayment and the company defaults on one of those payments and can't repay it? What happens if the convertible note matures after 2 years and the company defaults because it doesn't have the cash to pay off the note? Then we have to basically negotiate all these default provisions and what happens. What happens if the company fails to execute the notes before they become due, right? The company hasn't moved its business plan, and the company basically just has no leverage here against the investors, and the investors could even take over the company because it's a debt instrument. So again, it could be very complex here. If the company doesn't do well, having a creditor who could basically foreclose on the company is a bad day. Lastly, I want to talk about what happens if the investor, why the investors may not want to use convertible notes or safes. Well, the investor may not have any practical remedy, okay? So if the company's insolvent, even if they have a convertible note, and even if it's secured, maybe the collateral's worthless, company doesn't have any assets to pay. If it's a safe, the value's lost. But the point here is that the company just may not have any practical remedy, and it's a total loss type of situation. The discount may not compensate the investor for the risk, right? So what happens here if the company negotiates a 20% discount? Is that enough, right? Or are they safer coming in at a later round without a discount? There's a lot of risk coming in early in companies. So there are some investors who won't come in at this early stage because they don't think the return is worth the risk. There are other investors who all they do is come in at this stage. So it has to be a certain type of investor who appreciates and understands this risk to come in, but not every investor is that type of investor. And the flip side here is that you're taking on this early risk. And what happens if the company then grows in value very, very quickly? And what if we don't have a valuation cap? Or what if the valuation cap isn't low enough? Again, the company may lose value in that situation, which the investor may feel like they would have been better off coming in at equity in the first place. Another topic that's really important to think about, and this is happening, I would say, more and more. I've seen this happening more and more in the past few years than I did probably the last 10. Is what happens when the convertible note holder or the safe holder gets squeezed by the next investor. The point here is that the new investor may not want to invest in the company unless the holders agree to modify their rights, right? Here it is that the convertible note holders and the safe holders came in, they negotiated, for example, a 25% discount. Maybe they negotiated a $6 million valuation cap and the company is now being valued at $20 million by the new investor. And what happens if the new investor says the deal that these guys are getting is too rich? They're taking too much dollars off the table for themselves. They're basically coming in at a much better deal than us. And worse, it's diluting the company so much that the management team doesn't have a significant stake in the company to be motivated to work hard and grow the company. So in that type of situation, the new investor may say, we're willing to come in and write the big check, but we're not willing to come in on the terms negotiated by the prior investors we're only willing to come in if they come back and modify their instruments to something we consider more reasonable. And again, this is something that we've been seeing in more and more deals over the past few years than recently, is that the new investor kind of understands that they have the leverage here, and very often, try to squeeze the old investors to make sure that they have a better deal themselves, and more importantly, to make sure that the management team has enough equity in the company that they're motivated to work hard and make the investors money. Lastly, investors may not want to use convertible notes or SAFEs because maybe they're going to miss out on important tax advantages that they would have had they just invested in equity in the first place. There are certain key tax advantages that only apply to investments made in stock. The one that I want to talk about is what's referred to as the qualified small business stock exemption. Under that exemption, it basically says that the investor, if they buy stock in a C corporation, can basically exclude from capital gains, meaning they don't have to recognize that income, the greater of $10 million of their profit or 10 times their investment. So if they put in $2 million, they could exclude from capital gains $20 million. So that is a really beneficial tax provision. And for that reason, there are some investors who won't come in with convertible notes or SAFEs. They will only come in and buy stock of a company to make sure that they're in a position where they can try to avail themselves of these tax advantages. So that's it for the organized part of the presentation. I know I went quick through some things, and I wanted to give us at least some time here to do some Q&A. But what I really wanted to try to convey to you guys is what these things are. And I want to then try to convey to you guys some of the factors that are driving companies and investors to prefer one thing over the other. And so with that, I'll pause and we'll take questions.
Hey, Bart, this is JJ.
Yes.
I associate the safe note with Y Combinator. Maybe because they were an early advocate of this, and this goes back, what, 6, 7, 8 years, something like that?
Yeah. Yeah, more than early advocate of it. They actually drafted it. So they worked with their legal counsel, and they were the ones who drafted the safe note and came up with the concept. So this was their baby. So in fact, I believe if you're looking for the form, you go to the Y Combinator website, and there it is. And they're currently on, I think, the second iteration of the original form. The original form they kicked around for a few years, found there were some problems in it that they got a lot of feedback over the years. And then there was the second iteration, which basically addressed a lot of feedback that had come through on them.
This, you may not be privy. Are they still as bullish about it as they were?
I'm not aware of anything where they've changed that input. I mean, just one other thing I want to add here is that the SAFE was designed to be fairly even-handed, so that it didn't really favor the investor heavily over the company. Given that it's a little bit skewed to benefit the investor. But something that you guys may be aware of, and that we didn't talk about, is that there's another instrument called a KISS, okay, K-I-S-S, which is essentially a SAFE, but incredibly onerously favorable to the investor. And so what I can tell you is very few deals I've ever done with a KISS. It's just that never really gained traction because it was too onerous. But every now and then I come across an investor who wants to use it, but it's rare when we do see that.
Yeah, I have not seen one labeled or described as such, unless they can offer that type of that instrument without the name. So.
Yeah, I refer to it as the kiss of death, but yeah, that's right.
Thank you.
Any other questions?
Actually, I have another. So there are angel networks in Southern California that go out of their way now to avoid safe notes if they can. Do you recognize that trend, or is that just arbitrary that I've seen that?
So since I've not been actually practicing for 3 years, I can't really speak to the last 3 years or so, but what I can tell you is I've seen a lot of acceptance to SAFE. And I think the reason why is because most investors felt that the convertible note, even though it was a debt instrument, and even though it put the investor higher up on the liquidation waterfall, as a practical remedy, when a company fails, its assets aren't really worth a whole hell of a lot. In most of those circumstances, they typically wouldn't have any ability to repay the company. So from a legal perspective, although the convertible note was more beneficial, in practice and in reality, they didn't really see it that way. So I think to respond to your answer is, I think a lot depended upon what the company was comfortable doing. Now, naturally, if there's sometimes angel groups come in on existing, rounds that have already been negotiated, in which case they're just going to kind of jump in on what it is, and as long as they're okay with the terms. But I think all things being equal, I've never really seen the discussion as to whether or not the investor was willing to accept a convertible note or a SAFE kind of be a deal killer. It seems to me that they can always kind of work with it and get comfortable with it.
Yep. Let's say you have a startup coming to you, they want to create a SAFE or maybe a convertible note. Would you or would you have been able to help connect them with some potential investors, make some introductions on that front?
So, a lot of law firms say they do that, and some have better connections than others. But at the end of the day is, if the company's not ready to take on investors, or at least what I would say more sophisticated investors, then that's a really hard thing to do. And the investors we work with trust that we've kind of vetted the client to make sure that they're ready. Most of the clients who we start doing convertible notes and SAFEs for aren't really necessarily ready for professional investors. It may be more angel. I mean, not to say that angels aren't professional, but I'm talking about more like funds, venture funds. Angels are more willing to take the risk and do those types of transactions. We're always happy on our point to make introductions, but again, we have to have a good faith belief before we can refer it out to people that this is something that somebody may be willing to do. A lot of our convertible notes and SAFE transactions are really what I would call friends and family financings, where a client comes to us, they want to raise a few $100,000, $500,000, and they have a good Rolodex. They have some friends, service providers they work with who are willing to put some money in the company. That tends to be the very typical first financing that we engage with. When the company is really ready for more mature investors, then it becomes a question of whether or not it's a note SAFE or maybe going straight to the preferred stock round. So long answer, but the answer is yes, that's something we and other lawyers can do. The problem is it takes a lot of time and effort, and a lot of lawyers just don't have that time.
Thanks, sir.
Bart, I do have a different kind of question. Maybe it's a totally different topic, but curious, when someone wants to have one of those significant returns, with investing with a startup, say that 10x return, that 20 times return, all those are still achievable with these convertible note, SAFE, stock? Is that something that really is only subject to once there's a buyout?
Sure. So yes, I mean, all those returns are certainly achievable. The terms that are negotiated, will impact that, right? So I mean, for example, if I'm converting at a $1 million valuation instead of a $20 million valuation, then I'm already 20x ahead, right? And so the point here is that how successful or unsuccessful the company may be in negotiating terms will have a fairly significant impact on the investor as to what its ultimate return is. And obviously the investor is going to take these into consideration, and depending upon whether or not the investment makes sense. And so so if a startup is adamant about a $20 million valuation or $20 million cap, and the investor is adamant about $1 million maybe initial valuation and a $6 million cap, then the two just aren't going to get the deal done, right? So I mean, the investor is going to come in with an expectation, understanding that there's a path to get at least a 10x return. And if the terms that are negotiated with the company don't allow them to basically see that, then the deal isn't going to happen.
Thank you.
Hi, this is Helena again. I just wanted to follow up again, I guess, with that question. So essentially what you're saying is in order to get investors interested in the SAFE or the note route, you would eventually have to have a plan to go public.
No, didn't say that at all. Okay. So going public is one way of liquidating the company, causing a liquidation event. Okay. And that is rare. I mean, most companies don't go public. Most companies exit by doing a sale transaction, right? In other words, somebody buys them. And that is by far the most common situation where investors get cashed out. So, many situations, just say, for example, that the investor comes in at a $6 million valuation cap, right? And they convert their note over at 6 million. And let's say downstream, the company sells for 500 million. There's going to be some pretty good upside for the investor. So, where in the early 2000s, it was all about going public, it's just a lot harder now. And very few companies ever go public. What I can tell you in my 30 plus years of practice, I probably only had about less than a handful of clients who went public. And that's a function of Orange County as opposed to something over Silicon Valley. But the point here is I had a lot of clients who sold for $500 million or more. So that really is the preferred route of liquidating and cashing out the investors.
In the classroom, Bart, I refer to a capital event.
Okay.
Which is, could be an IPO, could be a sale, a merger, or I suppose you could say a BK is another capital event, right?
Yeah. And Helena, part of the reasons why public exits are so rare is that a lot of companies just don't want to take on the regulatory framework and obligations of being a public company, right? In other words, your financials are now public. You've got a whole lot of reporting obligations. You have to have audited financial statements. You can't have preferred stock. In other words, because it all converts over. The point here is there's a lot of reasons why companies don't want to go the public route. Where I would say that in the early 2000s, it was definitely the preferred approach for a lot of companies, and a lot of companies did incredibly well. But we'll probably find ourselves back, the pendulum always swings, both ways. We'll probably find ourselves in a situation where public becomes more attractive. Maybe that's very likely in the current administration, given the fact that, regulation is probably going to be, sliced away. And so it may be a lot easier to be a public company. On the other hand, without regulation, it might be a lot riskier to be an investor in a public company. So you just have to kind of weigh all those things.
Okay, thank you for clarifying that.
Yep.
That was Dodd-Frank that added on the regulation for public companies, right?
Yeah, I mean, Dodd-Frank really came out of the real estate, crisis, right, in 2007, 2009. And that was kind of the impetus behind that as far as, different disclosures and various things. But yeah, Dodd-Frank is one of many, right? I mean, of course, it started with the SEC Act of 1934, in which case it was the Great Depression, which was kind of the inspiration for some regulatory, framework.
That was a couple of years before my time, so not as familiar with that one.
Mine as well. But yeah, no, the point here is that, typically bad results and bad economic situations is what generates regulations, right? Because we see where people got hurt and where the defects were.
I would add to that disclosure requirement that if you're a public company can be a little onerous, that would be lawsuits, employee embezzlement, any nasty things that as a private company, you don't tell anybody about. But when you go public, you're mandated to put the dirty laundry out there.
Oh, exactly. Yeah, for that reason, a lot of people just don't want to be in the spotlight.
Curious question, Bart. Who would they usually sell to? Is this usually through a business broker? Is this through a venture capital? How does someone usually go about selling their company when they get to, $500 million mark?
Yeah, good question. So more mature companies tend to hire a a broker, investment banker who's going to basically broker the company. They'll prepare a book, memorandum on the company and distribute it. And so that's kind of the preferred path for larger, more mature companies. For smaller companies, it's probably going to be, at least for venture-backed finance or private equity finance, they're going to probably basically leverage their resources and look for buyers, as well as, maybe hiring an investment banker. For small mom and pop businesses, they'll probably, want to engage a small business broker to market the company. So the stage of the company, the complexity, and all those things will kind of determine who's the right person to help them. But in most circumstances, there's a broker involved. Sometimes fortuitously, a customer or a strategic partner will approach the company for a purchase transaction. And so sometimes the companies does a lot of transactions with the person who ultimately buys them.
Great, thank you. All right, do we have any other questions for Bart? I think that kind of concludes today's session. Bart, thank you so much for your time. Thank you for sharing your wisdom with us. We really appreciate it. I always learn something new every time. So thank you very much. All right, so for everyone else who is on the line, we are having these talks every 2 weeks. So please join us, kind of same bat time, same bat channel, if you know what that means. Basically, in 2 weeks, Wednesday at 6 p.m. Pacific time, we'll be having another guest speaker. And if you have any other questions, feel free to reach out to myself, Travis, JJ, any of the team at Cal State Fullerton, and we're happy to help you out. Thank you.
Great. Thanks, everyone. Bye.
Thank you, Bart.
Thank you.